If you are a 1099 earner or independent contractor, then you have one of the greatest opportunities to reduce your taxes. We already know that the tax law heavily favors business owners. And the good news is that when you earn 1099 income, the IRS considers you to be self-employed. This key characteristic opens the doors for you to take advantage of over 100 tax deductions and strategies that you can use to pay less taxes. As a licensed CPA, I have helped independent contractors reduce their taxes by thousands at mycpacoach.com, and today I want to share the most valuable strategies with you. All right, so first of all, what exactly is 1099 income? 1099 income is simply non-employment income. It is income that is earned outside of an employer. So if you are a freelancer, independent contractor, self-employed individual, or earn any income where taxes are not withheld from your paychecks, then you earn 1099 income. Now, when you earn 1099 income, you get paid first, write off your expenses second, and should only pay taxes on the remaining income if you know what you are doing. Normally, you would receive 1099 tax forms from the companies you worked for at the end of each year. This form reports the amount of income you receive. If you receive this, then you should report the income on Schedule C of your tax return. And even if you did not receive a 1099 form, you are still required to report all of your non-employment income. Now, the number one mistake I see 1099 earners make is that they fail to maximize their tax deductions. Some fail to take any tax deductions, while most people miss several. Part 2 of your Schedule C literally allows you to write off almost any expense from your vehicles, travel, meals, and all other expenses related to your trade or business. But so many people are misinformed about this. Some people think that they have to earn a certain amount of income in order to qualify for deductions. You do not. It does not matter if you earn $5,000 or $5 million. The tax code allows you to take deductions against your 1099 income. Another big one I see is that some people think that tax write-offs only apply to certain entities like LLCs or corporations. Also false. You do not have to incorporate your business to take tax write-offs. As a 1099 earner, you are already viewed as a sole proprietorship, which is simply an unincorporated business. An LLC does not grant you any additional tax write-offs. It's mainly just added legal protection. They use the exact same tax forms as you do. So let's spend some time here and help you master this so you can pay the least amount of taxes possible. And some of you may even want to go back and amend your prior tax returns to get more of your money back after overpaying your taxes. So let's start here with answering one simple question. What can you write off as a 1099 earner? Section 162 of the tax code allows you to write off all ordinary and necessary expenses you incur through your trade or business. As a 1099 earner, you can write off almost any expense that meets this criteria, even if you do not see it spelled out for you on your tax form. On the tax form, there is a box titled Other Expenses, which allows you to write off any qualifying deduction on your tax return. So again, any ordinary and necessary expense can be written off. But what exactly does this mean? An ordinary expense is one that is common and accepted in your industry. And a necessary one means that it is helpful and appropriate to run your type of business. In general, if the expense is incurred in the pursuit of earning income through your trade or business, it is tax deductible. Most of these tax write-offs will be very easy for you to catch, like your advertising expenses, legal and professional services you use, any office expenses you have, or the supplies and tools you need to operate your business. All you have to do is set up a business bank account and use that when paying for these expenses. That way you can easily tally up your deductions at the end of the year. And if you need help with that, I will link a low-cost bookkeeping vendor that I personally use to help me with things like this in the description below. With that said, some tax write-offs are less obvious than others that 90% of people miss every year. So I want to spend the remainder of this video going over the top tax deductions and strategies. So let's start by getting you a 20% tax write-off against all of your 1099 income with the QBI deduction. Now, this is a freebie tax deduction that grants a 20% deduction for simply being classified as a business owner. You will automatically qualify for this deduction if you earn less than $180,000 if you're single, or $360,000 with a spouse. And if you earn above this amount, you may still qualify, but there are more stringent requirements that relate to the type of business you do. I have an entire separate video on those requirements, so make sure that you are subscribed if you want to learn a little bit more about that. But now let's move on to the roof you have over your head and talk about the home office deduction. Now, this deduction allows you to write off a portion of your total home expenses under your business. It does not matter if you rent or own your home. If you have exclusive space in your home that is dedicated to working on your business, you can use this deduction. Even if you work outside of your home, you may still be able to take this deduction if you regularly use your home office to do any type of work for your business, even if it is just administrative work. If you qualify, you can write off 100% of your direct home office expenses, which are things you buy that are inside your home office. In addition to that, you can write off a portion of all of your indirect home expenses, which may include your rent or mortgage interest, your property taxes, home insurance, utilities, Wi-Fi, repairs, HOA fees, and depreciation. Think of it like your business is renting space in your home and you are the landlord that pays for all of the expenses inside of it. Because your business occupies space in your home, you can write off a portion of the total expenses that is attributable to the space it occupies. For example, if you have $100,000 in home expenses and use 10% of your home for your business, you can write off $10,000 with the home office deduction. But now let's step outside of your home and jump in the car. Let's talk about the vehicle tax deduction. So look, even if your car is in your personal name, you can write off the business usage of it under your business. Therefore, if you use your car in any way for your business, you can write off the portion of it that is applicable to your business. It doesn't matter if you use it 100% of the time for your business or 5% of the time for your business. You can write off the percentage of your car expenses that you use for the business with the actual expense method. But in addition to these car expenses, you can also write off some of the purchase price of the vehicle every year by using depreciation. And there are currently ways to take large amounts of depreciation thanks to something called bonus depreciation. Now, using these tax write-offs can save you thousands in taxes. But if you want an easier method, you can instead write off the business miles you drive under the standard mileage method. This method will give you a 67 cents deduction per mile you drive as of 2024. But anyway, let's jump out of the car and grab something to eat. Let's talk about the business meals deduction. As a 1099 contractor, you are able to write off certain restaurant meals or meals that you have catered from your income. All you have to do is enjoy these meals with a business contact and discuss a relevant business topic. These business contacts can even be your friends or family members if they are associated with the business in any way. They would either need to be a partner, employee, contractor, customer, prospective customer, board member, or some type of business contact in order to qualify. Now remember, in order for your expenses to be tax deductible, it must be necessary for the business. You must discuss things that can be beneficial for your business in order to write it off. And to prove this, you should also keep up with your receipts, meeting notes, and other documentation as backup for this write-off if you are ever questioned about it. With that said, let's get out of this restaurant and head to the airport and talk about writing off some of your travel expenses. So like everything else I've covered so far, if you have a business purpose for your travel, you can write it off under your business. This includes your flights, hotel expenses, meals, and transportation costs directly related to the purpose of your business travel. Now, typically, use cases for business travel include travel to board meetings, conferences, seminars, or meetings with business contacts. So if you want to write off your travel expenses, try to incorporate some business during your travel so you can write off these expenses to pay less taxes. If the trip is 100% for business, then you can write off 100% of those expenses. Now let's come back from our business trip and talk about one of the biggest expenses most 1099 earners have: health insurance. So many people miss this easy tax write-off, it is not even funny. So Section 162 of the tax code allows self-employed individuals to write off their health insurance premiums. It does not matter if the policy is in your business name, your name, or your spouse's name. If you pay for the insurance in any way, you can likely write it off as a business expense on your tax return. Even if you are covered by your spouse's plan and their employer pays a portion of your health insurance policy, it does not matter. You can still write off the portion that your household pays. The business can either pay it directly to write it off or reimburse you for the expense in order to deduct it. Anyway, the deductions we've covered so far are things you may already be paying for but may not be writing off. Remember, any expense that is beneficial for your business can likely be written off, and your CPA should be doing this on your tax return. But now I want to fast forward past deductions you may be missing. I want to talk about how you can create tax write-offs. So as a business owner, you can create tax write-offs through moving, investing, or spending your money in a certain way. So let's talk about the most popular tax write-offs you can create as a 1099 contractor. Let's start with retirement. So let's be real here. You are probably going to retire one day. And when you do, you will need money for it. And when you move money into a retirement savings account, you can receive a tax write-off equal to your contribution. All you would have to do is transfer money to a traditional IRA, which is simply an individual retirement account. Now, this is not connected to your business in any way. Or you can set up a traditional 401k, which is a retirement account sponsored by your business. And the good news is that you can set up something like this for free at a place like Vanguard or Fidelity. Now, if you have no employees, then you can set up what is called a solo 401k plan. As of 2024, this plan would allow you to put up to $69,000 into your retirement account in 1 year. And whatever amount you contribute will be tax deductible. Now, the exact amount of money you can put into an account like this will ultimately depend on your income from your business. You are typically limited to a certain percentage of your income. But I have videos on this channel already that fully explains all of this, from when to use a Roth versus a traditional retirement plan to the best self-employed retirement structures in general. So just make sure you're subscribed and check those out. Now, another tax write-off you can create is by moving money into a health savings account. Almost everyone will have health expenses at some point, whether it's medical, dental, or expenses to maintain your general health and wellness. And when you pay for these expenses from your HSA, you are effectively writing off those expenses. And here is how. So when you put money into your HSA, you receive an immediate tax deduction. And while the money sits there, you can also invest it. And all of the income generated inside of your HSA is also tax-free to you. Then finally, when you use your HSA to pay for qualified health expenses, the money comes out tax-free. So you will practically never pay tax on money you move into it. Now, outside of your retirement, in your health, there is something else that may cost you a whole lot of money: your family. Whether you have kids that cost you an arm and a leg, a spouse, or parents that you financially support, you can effectively write them off as a business expense. All you have to do is give them a job in your business. You can hire them as an employee, contractor, consultant, board member, or even make them partners in your business depending on your circumstances. So instead of just giving them money, give them a job. That way, when you pay them, the expense is tax deductible for you, and they still receive the money to do the things they were going to do with it anyway. Plus, depending on their income, they may owe no tax at all if they earn less than the standard deduction, or even if they owe some tax, it will probably be at a lower tax rate than yours since you provide for them in some way. In most cases, this ends up saving you money, but you will need to do some planning around how you want to involve your family in your business. Now, some 1099 contractors are able to use these write-offs to reduce their taxes to almost zero. But if you've taken all of these write-offs and are still reporting over $50,000 in taxable income from your business, then we need to talk about optimizing your entity to save you thousands more in taxes. So earlier, I told you that having an LLC or corporation does not grant you more tax write-offs. This is true. However, these entities can be taxed differently. And as your income rises, some of these tax differences can save you thousands of dollars in additional taxes. So let's talk about one additional tax that every 1099 earner will have to pay: self-employment tax. This is an additional 15.3% tax on all of your business net income. But certain entities do not pay this tax at all, specifically S corporations and C corporations. And if you simply choose to be taxed as one of these, then you could avoid up to 60 to 70% of your self-employment tax liability. And by the way, if you already have an LLC, then you can simply ask the IRS to be taxed as either one of these for tax purposes, which would grant you the same tax benefits. Now, whenever you change your entity, keep in mind that there will be additional rules you have to comply with and additional tax returns, which typically means additional costs. And that's why most CPAs recommend earning at least $50,000 in taxable income before pursuing these changes. I have a separate video that walks you through how to choose the best entity for every stage of your business, so feel free to watch that next. Or if you want immediate tax assistance, like right now, from one of our CPAs, just apply to become a client today at mycpacoach.com.